Good evening, ladies and gentlemen. On behalf of HSBC Mutual Fund, I extend a very, very warm welcome to all our participants in a very insightful call on equity markets and the recent developments. I think the more I say, the less it is, because equity markets have been behaving the way they should be behaving in a very unexpected manner. I think it all started with the direction changing in the month of September last year, when foreign investors started selling oodles of dollars and started exiting partially their profits, which they had made over the last 3 to 4 years. Now, this trend continued, and people kind of started believing the fact that this is again a kind of a monotonous trend, and we would not see or feel any reprieve from this selling. As is the nature of equity markets, they again surprised us once again. And the month of March has been a relief. It's been a breather. It's been a partial recovery, and markets across segments recovered between, I think, 7 to 8%. If you look at mid caps, large caps, and small caps. So with all this happening, and of course, without we can't afford to discount or forget the international developments. I think with Donald Trump and his advocacies and his statements shaking the markets more than the ground reality, I think we felt that it is the right time to have one more expert from the house of HSBC Mutual Fund to share her views on markets, on international developments. So today's session, I promise, is going to be a very insightful and a very invigorating one. We have one of the best in our investment team to address you and your queries. Without further ado, let me introduce the fund manager, our speaker for the day, Cheenu Gupta. Cheenu is an equity fund manager at HSBC Mutual Fund India and brings with her around 20 years of rich experience. Before joining HSBC, Cheenu was working in a similar role at L&T Mutual Fund. Prior to that, Cheenu worked with Canara Robeco Asset Management, where she was again an equity fund manager responsible for managing some of the very flagship schemes like the Equity Tax Saver, Equity Hybrid, Consumer Trends, Small Cap and Infrastructure Fund. Cheenu was also associated with Tata AIA Life Insurance as an equity fund manager, with ING Investment Managers as a senior research analyst, and also with UTI Mutual Fund as an analyst. As an analyst, she had some great picks in pharma, in consumption, and in oil and gas sectors. Talking about her educational and professional background, Cheenu is a CFA charter holder USA and has completed her PGDBM from SP Jain, Mumbai, where she was a gold medalist in finance specialization. Cheenu has a BE in information technology from Visit Mumbai University. Also, in her spare time, Cheenu loves reading and traveling. She also enjoys practicing yoga, visiting museums, and playing table tennis. So, with that, I welcome Cheenu. Cheenu, very, very exciting times, extremely interesting times. And thank you for taking time out of the dealing room where you'll be busy buying and selling stocks and managing portfolios of our customers and our partners. So we have our partners on the call today. What we are going to do today is slightly different. So Cheenu, this time, rather than you having a monologue and sharing data and slides and insights with our partners on the call, I have collated some very interesting and thought-provoking questions on behalf of our partners. So we can do it slightly more engaging, in an engaging manner. I can ask you those questions, and one by one, to support those questions, you may want to take us through the presentation and share your insights. So amidst the tariff talks, economic growth forecasts are getting cut, and this is happening not only in the US but all across the world. So, Cheenu, what is your assessment on the impact of tariff cuts on the various economies and various equity markets in the world that you track?
So thanks, Rajat. Thanks for that elaborate introduction. And coming to the on markets. So I think, yes, tariffs are important, but much more important is the global uncertainty environment that has just come in last 2-3 months. Earlier, there was this expectation that once the US president comes in, and now with Trump coming in, there will be a single-minded focus on how things would come up. But the way he's begun, it's a lot more erratic. And yes, tariffs have occupied a center stage. It's like the carrot and stick approach that he's been using for all his negotiations. And to a large extent, this tariffs and the negotiation that he's doing behind them, they've impacted not only other countries, but US economy as well. In fact, if I have to just take you through some numbers, I hope you can see this on the slide.
Yes.
Yeah. So just to see, look at the growth forecast the way US growth forecasts have changed over time, right? So
Mm.
you can see the previous baseline in the light blue that was there. So that was the expectation of the GDP growth for US economy. And today, as we are talking, the expectation has already come down to a large extent. And in fact, there's the risk scenario which is getting built in, the recessionary environment that we are talking about, that there are chances of even a recession happening because of these things. I think that is what is the risk we are looking at. So these are some things which are happening as we are talking, and just last 2-3 months have seen these panning out to a large extent. And to start with, the US debt to GDP situation is not very pleasant. Look at the environment where we are speaking. US debt to GDP is like at an all-time high. It was almost similar to World War II situation where it was that high. Apart from that, look at what has happened to the consumption scenario. Whereas we were expecting strength in US economy, situation has just reversed to a very large extent. So the outlook for consumption has just dropped drastically. I think it's on back of the uncertainty again. And again, look at what has happened to inflation expectation. Whereas we were saying that the battle with inflation is over now, we've come up after a long time. But again, with these tariffs unfolding, I think inflation again becomes like a black box as to what will happen in the economy. So these are some of the concerns with the tariffs.
No, absolutely. I think, everything that glitters is not gold, and we are talking about markets and the real economy. So, in contrast to the expectations that were built up, things are really turning a little dark now, which maybe you don't know. I mean, you are in a better position to say probably a silver lining for countries like India. Now, coming and staying with the question on tariffs, Cheenu, how are the tariff changes expected to impact the earnings outlook for various sectors and equity markets over the medium to long term, especially in India?
So Rajat, it's very right that we have to look at how the impact flows down to India. But before that, I think just talking about, I'll start with the situation in US. Why is US fighting this battle? Look at how the manufacturing as a percentage of GDP has changed in US. It's come down from where it used to be almost 13% to 10%. So it is indeed an alarming situation that has happened for the US. And that is the reason our US is trying everything to get that manufacturing scenario back into the country. So they're trying to say that we'll impose tariffs on you. Only if you manufacture in India, in US, we won't do that. So this is a scenario where they're coming from. Unlike India, we are at a low manufacturing base and we want to take it higher. For them, it's just the reverse. They were higher and they have been coming down. So that's what they are fighting. Again, what they are fighting is, and when we say recessionary scenario, most of the jobs in US that have been created over the last few years have been in the US government. I think this data was in fact very interesting. And now we are talking of all this cutting down of employees with Doge, etc. coming in, yes, of US government. So this scenario can be very, very striking for US with government take up of employees coming off, and either ways the private hires, you can see they have not been particularly strong. So this is the scenario that US is fighting. And now putting the Indian context to it, look at how the import export scenario of India is in the entire basket of US. You will struggle to find out that US imports 3% out of the total imports that US does. Only 3% is from India. And again, when US exports, only 2% of its export come to India. So in the entire scene, we are really, really very small. They need not tackle us single-handedly the way they need to tackle China. They need to tackle Mexico, Canada. It won't happen. But I think they have adopted this reciprocal tariff, and that is where the situation has become different. And so when you're talking about sectors, so if you look at the export of India to US, which are these various things we are talking about? So it's the electrical machines, equipment export. Smartphone, largely they've come up because we've been assembling these smartphones and exporting to US. Gems and jewelry, textile, pharma, engineering, etc. And you can see the breakup. In fact, IT, which is there below, is another area, just that IT wouldn't be impacted by tariffs directly because it's a services part and
services industry.
So the good thing is that is insulated from tariffs, right? When it comes to the other segment, I think pharma particularly stands out because in terms of generic volumes, India actually exports 40% to US. So 40% of generic volumes in US are comprised of Indian pharmaceutical. By value, it's very small. It's single digit, but by volume, it's big. So if they impose any tariff, I think the impact will be much more on US customers who are facing the brunt rather than India. And India being the cheapest exporter, I think somewhere more than half of the impact could be easily passed on in pricing. That is what we believe. If I talk about other segment like electrical, electronics, what is the other alternative for US? Almost 80% of import of US in that category are coming from China. If they put tariffs on India, and India is either ways exporting just 10% of it, what happens? Do they go back to China again? So that is a question you're facing. You put tariffs on India, but then do you want the imports to be just coming from China to you or some countries affiliated to China? So I think these are very tricky questions. And that's the reason that next week is going to be very interesting, where some discussions will be going on between the Indian government and the US government. We do expect some announcements, and obviously that 2nd April date, the date of reciprocal tariffs to come in, I think that's there. We believe after that, there could be some amount of semblance happening. As of now, I would not want to put a direct number of impact on any sector. So let's wait what happens on the announcement of 2nd April, and then let's take it forward.
Yeah, I think that's a very good synopsis of the entire situation. And Cheenu, I completely agree with you that this is an evolving situation. 2nd April, everybody's fingers are crossed, and that date is now, thankfully, it is not the 1st of April, because half the world would not have believed what would have happened. But on a serious note, I think the point that you made, that what are the alternatives? Then you rely completely on China. It's like the US is right now stuck between the rock and a hard place. So whatever measures they take and whatever actions they take will be very, very well thought, with serious implications being figured in. So I agree to that. Moving away a little bit from tariffs and probably talking about the general economy, the economy at large, our partners would want to know from you. So how does the domestic scenario pan out with respect to some indicators of the economy? For example, if you can comment a little bit on the GDP growth, on the inflation which is trending in the country, fiscal deficit, those kind of macro factors, if you can share your views on in India.
Sure, Rajat. Yeah, let me see if there are some.
Yeah.
So I think GDP growth is something very, very critical. And in fact, we also have been monitoring that to a large extent. And this is one number which has changed for us, right? We began the year by saying that in FY25, we'll have a GDP growth of almost 7. In fact, 7.2% was what RBI was saying. Yeah. Those numbers were cut earlier to 6.8 and then to 6.5. And now today, as we're talking, we're saying probably 6.3% is where we'll end. So this has been one of the biggest concerns, this decline in GDP, which looks kind of cyclical in nature to an extent, because the consumption demand is cyclical. After 1 or 2 good years of recovery post-COVID, maybe there is some bit of softening in the consumption demand. Apart from that, we also saw that when it came to spending by the government, because of elections and other reasons, earlier there was slowdown. Apart from that, even the state governments have not kind of spent as much on the capex. So various reasons put together, yes, GDP number has become something to be monitored and maybe some bit of concern. Good thing is, as we are going into next year, there is acknowledgement of this problem, and various measures have been taken by the government and RBI to try and to push this GDP number higher. How it unfolds, how it gets into the numbers later, I think this is something that we'll watch. Fiscal deficit is something we need not be concerned, because this is one thing government is doing it very, under tight measures. Yeah, they are achieving their targets, in fact, overachieving their targets. Maybe they might have some leeway next year if they have to push growth and they have to go lighter on their targets of fiscal deficit. I think that can act as a cushion. Coming over to the next number, before inflation, let's talk about crude. Good thing with Trump coming in is the way he's spoken on crude, and he said that he wants to produce a lot of crude from US. This is one parameter which has just gone down the risk radar. So crude inflation is now out of our concern basket. Crude volatility should be much lower. We should be blessed with a benign crude, which is very good for India. And based on that, look at the inflation expectation. Inflation expectation in India relatively is much more moderate, unlike what we are witnessing in US, right? For some reason, and maybe with protectionism, even Europe can see higher inflation. But I think India that way is pretty much under control. And in fact, policy easing has commenced across the globe and in India too. So last monetary policy, we saw some easing by the RBI governor. And I think in next policy also, there is expectation of this easing. And mind you, this was not a given scenario. When we began the year again, there was hardly any expectation of easing for at least first half of the year, but
Yeah.
that has happened. So maybe this volatility and uncertainty has also led the people to act on the monetary policy, and that has been the scenario.
Yeah, and I think a very interesting point that you made, that we import a lot of inflation through oil, and oil is now actually not on the boil, as they say. In fact, yesterday, another very favorable development to keep oil prices low was the agreement reached by Russia and Ukraine on the Black Sea. So I think all these things are kind of reducing the inflationary pressures on India. And I believe, Cheenu, you talked about oil, but even on the food side, on the food inflation, I think things are good. I remember hearing you in some other call where you mentioned that the Kharif harvest has been good and the Rabi crop sowing has also been very favorable. So that should also ease out food distribution and supply. Is that correct?
Very true, Rajat. Yeah.
Okay, all right. Thank you. So, Chino, so I think the economy is in good health relative to the world. We are growing at a good rate, even if it's 6.5%. It's one of the best rates that you can get from a stable government, a sovereign country. Moving on to the earnings outlook. So, all this thing about large caps being more favorable or mid and small caps having corrected more. If you can just comment on the earnings outlook of the three segments: large caps, mid caps, and small caps.
Yes. So I think, yeah, very pertinent to see what has happened. So just putting now these earnings growth into larger context, just
Okay.
trying to show that usually you will see the stock market returns, the GDP growth, and the earnings growth are somewhere very closely related. So the kind of CAGR that you can see over the larger period, you can see it's a very narrow range of 10 to 12% earnings growth that we've witnessed. Some years it's a bit higher, and the other years it's more, to cover up. Now, what happened in FY25, if you look at the numbers that you can see here on the screen, 1005 and 1054, which is saying that we actually stopped at a growth of just 5%. So the earnings growth for FY25, whereas we began the year by saying there would be a 13% growth expectation on Nifty, we ended the year with just a 5% growth, maybe a quarter to go, but this is very close to where we'll end. So this is the earnings cut that has happened, and various things have gone into it. Part of it has been the GDP decline that we've seen in the country and the global uncertainty to add into it. So this year, FY25 earnings cut has been there, and this is what has led to disappointment in the market. If I look at FY26 and 27, right now the estimates are again back to that 13 to 15% expectation. Looks like that for FY26, because the base has been set relatively lower, maybe we may not be closer to 15%, but 12-13% looks like a relatively achievable number, which is that way benign for the market. Consider it. Now, this is the Nifty 50 that we're talking about. If I talk about the mid and small caps, I think there what happened is the earnings expectation earlier was significantly higher. So a mid cap, we are ending the year with a 17% growth, not a low number. Yes, last year was 10%. 17%, maybe we started the year with 23% kind of growth expectation. So that has been the reduction. However, again, the outlook still stands at 23% growth for FY26. So I think that is what one needs to watch, whether these numbers can be met. If I look on the right hand side, you can see the PE graph as well, right? Because interesting thing is this market correction has got the valuation at least in that one standard deviation zone. We are not saying we are cheap, but at least we are not that expensive the way we had shot up. So that is the comforting factor on the mid caps. If I look on the small cap side, I think situation is similar. FY25, big cut in small cap. Almost 15% kind of earnings cut happened for the small cap, as a result of which we are ending the year with 7% growth, slightly muted. Again, expectation remain high, but maybe this would be my watch out zone, because usually we say that in a benign environment where GDP growth is inching up, your small caps tend to do better than what is expected. And in the reverse scenario where uncertainty just puts up higher, there are chances of small caps missing on the earnings growth, which is relatively higher versus the mid cap, so or the large cap. So I think this is how I would put it. And you can look at the valuation. Even for the small cap, the valuations have that ways inched down post this correction.
No, very aptly put, Chinu. And I think last year, or maybe November or December of last year, we were all talking about mid and small caps being two standard deviations higher than the average mean. And now you mentioned that it is actually dropped by one standard deviation. So we are probably looking at, India will never come cheap or inexpensive because quality is there in India. But looking at relative valuations, we are now in a much more comfortable zone than what we were probably last year. So that's a good outlook. And you covered valuations along with earnings. Chinu, they always say that your best friend is volatility, right? A fund manager's best friend is market volatility, and it has always kind of bewildered me as to how do you find comfort and find all of these opportunities when the markets are bouncing. They're 3% down, and this week they're 6% up or whatever. So, what are your comments on the volatility that you have experienced in the last 3 to 4 months?
So, Rajat, yes, I must express that this volatility has been very extreme. We were
Hmm.
expecting somewhat sideways market saying that, okay, earnings are being cut, but the volatility has been just very sharp. And two things which have been at the back of it has been the sharp FI outflows. They've been far higher in numbers that were there. And added to that, I think the domestic, there was some kind of panic in the market where they saw that, okay, markets have run up to a large extent and everybody wanted to be the first to kind of book profits out of the market. So if I comment on the view of what happened in last 3 months, I think it was more like a panic stricken market. There has been rear view mirror selling,
Hmm.
saying that any stock which had done well in the past got sold. So people were not willing to look at how the future pans out. It was much more saying that, okay, any stock which had not done well may not have been impacted, but with any stock which did well, I think that got largely impacted. The market is obviously in a risk off mode as we talk, with the kind of news flow that you're saying it's coming in. And I think I've just put down for saying that what is happening right now is if there's positive news, gets ignored. If there's good results, gets ignored. But if there's anything negative, if there's a slight miss on earnings, I think that gets extrapolated. It is just the reverse of what happens in a very bullish market, right? It's just the opposite of what's happening. We believe that, okay, kind of we are almost at the bottom. There is some bit of settling in. After 5 6 days of good run, you see 1 2 days of correction, but then this is the kind of settling which happens
Yeah.
after very sharp correction. You tend to see some bounce and then some settling in. uh, Again, you've spoken about the correction and bounce back that we've seen. We still believe that, okay, market will take some more time to get that confidence, but probably we'll be here to use this opportunity and build up portfolio and build up on our conviction picks as time goes.
Yeah, that's an interesting view, and I completely believe that the fact that this is transitory in nature, and I think we are in for a very long structural bull run in this country. We are blessed with that. Moving on to the flows, you touched upon the FII selling. So if I'm not wrong, Chinu, I think since September, FIIs barring 1 month, I think it was the month of November when they bought, they have been net sellers, including the month of March, whatever we have seen, although we agree that the FII selling has reduced in its intensity. If I'm correct, even the domestic investor selling has been extremely strong. So the DIIs, the buying, the DIIs have been buyers. They have not been selling, and a lot of supply in the market is being absorbed by the DIIs. So, what is your view on the trends that we have seen in the last 7 months, both from an FII and a DII perspective? And also, a leading question to that is: do you expect the FIIs to reverse their outflows and to become net buyers anytime soon?
Sure, sure. I think very, very apt question, and I think which is there on everybody's mind. Starting with FI positioning, right? Look at how the FI positioning has changed in India. I think it's like an all-time low. So the first graph actually shows you the underweight positioning of FIs in India. So FIs are right now at a very big underweight in India. To that extent, we say that if there is anything positive happening, and positive triggers can come in the form of some earnings upgrade, maybe a couple of quarters later, or maybe GDP rebound if we see that happens, or sheer pressure of other markets not doing well can push FIs to come into this market and buy because they are at a relatively underweight position in India right now. If I look at the emerging market entire emerging market have seen outflows. We know the trades that were happening last year, right? Go to US. The US trade was on because of Trump. Now it looks like that trade is kind of coming to an end. And to an extent, we've seen earlier China benefited, especially the tech in China, and even the European markets for whom things are not going anywhere positive. But I think that sheer money outflow from US, I think that has benefited these two markets already. So I think it's a matter of time when these flows start coming to India. Earlier, rupee depreciation was like one of a very big concern. We had seen very fast depreciation of rupee that had happened, and I must say that to an extent we were expecting another 2-3% more depreciation. However,
That is not happening.
before that, dollar went reverse, and
Correct.
almost all the currencies have seen appreciation, and rupee too went back. So today we are just sitting at like 2-3% kind of depreciation, which is not very significant. So
Yeah.
that has been another thing in the favor, and this is the flows that we've been talking
Hmm.
about. So
Hmm.
FI flows, yes, very drastically negative. First time like 6 months in a row, constant selling, and maybe that's the reason that last few days, I think last 5 trading sessions, where we've seen almost 19,000 crores of buying by FI is already being done in just 5 sessions. So
Yeah.
it is because we are sitting on such large outflows already. We are not saying structurally or constructively they'll turn positive, but because it's on back of such large outflow, you might see some inflows coming in just to balance these out. Meanwhile, what has benefited us is the DI flows, which have been very strong. There was this fear that with markets not having given positive return in last 1 year, I think just a month back we were sitting on almost 0% return from market in a year's time.
Yeah.
Today, as we are talking, the returns have actually moved up to 8%, which is still
Correct.
okay.
Correct.
But these concerns have started coming in that what happens if domestic investors kind of reverse. I would say that with the kind of understanding the investors have now got, yes, the flows can come down. Everybody likes to see good positive returns and then put in money, natural tendency, and exactly opposite of what behavior one should ideally expect. But so flows can come down, but we do not think that the domestic investor would turn reverse and start doing outflows when markets are down. So that
Yeah.
much of learning, maturity by the partners, by various MFDs, I think that has gone into the market, and that has helped in keeping these domestic flows robust in the face of such high market volatility.
Yeah, I think the investors, the domestic investors, in the institution investors have much deeper understanding now, and this is a trend which we have seen since COVID happened. If you recall, even during the COVID correction, the correction which happened post December 22, which lasted for 6-7 months, which very conveniently a lot of people have forgotten. All these times, I think the domestic investors showed much more gravitas, much more maturity, and they continued with that. So foreign investors, as the trends are showing, as the trend lines are showing, they have reduced and decreased the intensity of selling, and hopefully in the near future they will become positive as well. Yeah, that's the view which I am
Just
taking from
underlining
you.
it with their ownership, which we all very well know that FI
Yeah,
to DI ownership, if you track at this number
have
itself,
decreased.
I think
Yeah,
it's come down very significantly. It's a matter of time where it starts looking 1:1 is what we believe.
correct. Thank you, Cheenu, for that. It was a very important question, and thanks for answering that in a direct fashion. Okay, a generic question, which a lot of people ask. So, a little bit of crystal ball gazing. So, today we are at a certain level. We've recovered about 7% from our all-time lows in the last week of February. Today we are at the third week of March. Where do you see the markets from here on? What are those couple of triggers which you feel will give a direction to the market?
Yeah. So I think the first thing that I started with by saying is the GDP number. This is a very
Yeah.
important number to track whether we are coming out from the lows that we had seen. Now, September numbers were the most dampened numbers. Post that, December numbers have been somewhat better. And as I said, post the monetary and fiscal stimulus, which were announced, let's see if the GDP numbers start rebounding. So this would be one of the key things to track in terms of trigger. How we can start going. Apart from that, I think capital expenditure government has been in line. We cannot call it euphoria because in last few years it was like 20% plus CAGR in capital expenditure. On that high base, the numbers are bound to come down. So we are looking at 10% CAGR now going onwards from here, but I think that's still a healthy number to look at investments. And this is the tax relief, etc., and other measures which are coming by cash transfer scheme, which we believe that can give a baseline to consumption, which is ebbing. So we have to track whether these consumption numbers start rebounding for various companies.
Okay. Okay, so typically you're looking at earnings, you're following the capital capex spending by the government, and you're looking at the inflation number. So this is typically these are some of the data points and triggers.
Okay. And just now leaving you with this, we always talk of CAGR,
Hmm.
returns of the market,
Hmm.
and I
Hmm.
just put this table for some understanding of how the 1, 2, 3, 5, and 10-year CAGR looks. Maybe 5-year can be an exception because it's like the
Okay.
COVID base.
Yeah.
So
Yeah.
everything will look very good from the March of 2020,
Low
which
base
can be
effect.
ignored. Yeah, low base effect. So ignore the 5-year number. But I think 3-year gives a very decent picture where we are saying a large cap CAGR of 13% in 3 years is nothing exorbitant. Mid cap 21%. Maybe if we have a year's time where you're looking at maybe 10% on mid cap, then this CAGR can come down
Come
relatively
down
to
to
somewhere
slightly.
18%, which can be very healthy. Small cap, you're already at 18%. So for an economy which can show you a nominal GDP growth of 10,
11%.
12%, I think these kind of returns are not out of the whack. So 3-year CAGR of Nifty 500 of 14% doesn't look out of the whack. Multi-cap return, which is like large, mid, and small combined, 50, 25, 25, 16%. So I
Yeah.
just put these numbers in perspective to show that 3-year CAGRs are pretty much okay. So what do we see from here? Maybe the way 1-year returns are single digit, maybe another year of some bit consolidation. So we are saying that 2 to 4 months, you might get these ups and downs, where you're consolidating with the market. But this is the good time to build your portfolio into places where
Absolutely.
you have conviction. Market might
Absolutely.
look very dicey and you might just lose confidence. But I think we are just watching out for areas and spaces where we are getting confidence that earnings are not getting impacted. So looking at those areas, and I think one important point to remember is risk reward will always go hand in hand. If the portfolio is not taking any risk, I think the rewards in any upside will be limited. But
Yeah.
if the portfolio takes risk, there is reward. At the same time, if there's correction, there is bound to be some downside. So risk reward equation always gets managed in portfolios. And again, as we are saying, things can take some time to play out, but some bit of patience and earning scrutiny, I think that can really help the portfolio.
Yeah,
Maybe,
absolutely. Yeah, go ahead.
yeah, no, go ahead, Rajat, if you're.
No, no, I said absolutely right. And the fact that you mentioned that these are times to accumulate mutual fund units, stocks, and you are doing the same with stocks with the fiduciary responsibility that you have, Cheenu. I think a lot of people have also taken heart from the recovery that we have experienced in the last 15 days, that markets can shock you on both the sides. They have been disappointing us for the last 4.5 months, and there has been a pleasant, unexpected surprise in the last 15 days. So there you go.
Yeah. And maybe in next 2 quarters. So we are not calling for a sharp V-shaped recovery and saying that, okay,
Hmm.
you've seen 7-8% and now again bazooka 7-8% here. It's not that kind of V-shaped recovery. Consolidation is what is happening. So after a sharp fall, some bounce back. Now maybe we'll remain here, as I said, for 2-4 months. And in 2 quarters, ideally, what should change is that the earnings cut that we were witnessing, I think that should come to an end. And we should be entering a period where we should have a base which is already weak and we'll start seeing some earning increases getting built in. So that is something which is positive. GDP, I already spoke about how these various stimulus should help us at least seeing some bit of rebound. And I think globally in 2 quarters, there should be some semblance of where things are panning out, some stability. You cannot keep on doing new things after 2 quarters. So maybe in 2 quarters' time, capex investments can start because everybody is right now just hit the pause button. We don't know
Hmm.
what's happening. How can we do capex? If you're thinking of some new IT spends, maybe they cannot happen. But I
Yeah.
do not think that in 2 quarters' time, this volatility in policy making will continue. So maybe 2 quarters time for these things to come to an end, and which is when people will actually start spending and doing their IT spend or capex spend, and then things can look relatively better. So I think this is
No,
how we're looking at the markets.
very interesting point you made on the uncertainty. In fact, one of our global HSBC asset management economists, somebody I follow very keenly, has mentioned about the uncertainty trades. And he's saying that, the uncertainty trades, not only in India, but globally, are the ones which are, being done right now. And when, like you said, semblance should come in and people should start moving away from uncertainty trades and start looking at core businesses and then start investing. So that should again happen in the next 2 to 3 months. Thanks, Cheenu, for that. So I think what we have covered in the last 30 minutes or so, we started, and I'm just doing a recap for some of our partners who would have joined a little late in the call. So we started by talking about the impact of tariffs measures in India and the world and how the economy is looking like globally. Then we also came to India and we talked about some of the factors impacting earnings in India. What impact would tariffs have specifically on certain sectors in India? Cheenu was able to share some significant data numbers, very, very important impact numbers on sectors and which are involved in exports. Cheenu shared her views on some of the macro factors in India. She talked about the Indian economy, the GDP, inflation, fiscal numbers, etc., etc. And in the last few slides, I think we asked Cheenu about her views on FII, DII flows and how the market's volatility, what is the kind of volatility she's experiencing, and how, as a fund manager, she's able to capitalize on this bout of volatility. Because, like they say, volatility is the fund manager's friend. So I think this is what we have covered so far. Chinu, now we'll take a detour and we'll talk about HSBC Mutual Fund and the investment capabilities that we have, the investment strategies that you and your colleagues follow. So one question which we keep on receiving, and we've got it again from our partners today, is in general, what would be the common investment strategy when it comes to equity from HSBC Mutual Fund? It's not only pertaining to you, the way you manage, but in general, what is the feeling? What are you looking at as a fund house?
So I think, Rajat, the first thing that stems from the way we think about investing is we are here to invest to do wealth creation for investors at large.
Okay.
And when you say wealth creation, that cannot happen by investing solely in the large cap companies that are there in India. They can act as very well defensive in such market. We ourselves are taking cognizance of that fact, and we have kind of tweaked our portfolio for the interim, to safeguard in this market. However, when it comes to a 2 to 3 year horizon, and if I am actually talking wealth creation from equity, one cannot do without the mid and small cap stocks in the portfolio. So we do believe that we are part of this wealth creation journey for our investors, and hence we will, as a house, continue to back these names. Tactically, we might do some switching. I think the way I've done in some of my funds, reduce small cap in this uncertain times and maybe added some bit in large cap. But that's more like tactical calls. Structurally, as a house, we'll go bottom up and we'll pick up stocks where we have conviction. So I think that as a house, we'll continue to back. That will be a bottom up stock picking house, and we'll pick up sectors, we'll pick up stocks where we see visibility of earnings and we see ability for them to create wealth for our investors. I think this is the principle that we have always stuck by, and we will stick to even going ahead in future.
Yeah, so it's purely based on the merit of the business and the merit of the earnings, and not basis the fact that it is classified in the top 100 or the next 150 or the next 250. I get your point completely, and I think that's the most prudent long-term way of creating wealth for investors. So, Chinu, you partially answered the next question which I was going to ask, but if you can just add a little bit more color on the breakup, the large cap, mid cap, small cap allocation. So I think post the correction in the last 5 to 6 months, clearly, and you mentioned that there is a valuation discount which is coming in relative to where we were 6 months back, right? You showed that slide on how large caps are and valued, and the one standard deviation, valuation premium that we are experiencing in mid caps and small caps. So do you think now the valuations are apt and prime for making fresh entries into, all these segments, large cap, mid cap, and small cap? And a follow-up question to that would be, as per HSBC Fund House, as per HSBC Mutual Fund, which market caps do your portfolios are right now, are they overweight on? Are they overweight on large caps? Are they overweight on mid and small caps? And how is this expected to pan out over the next few months, this allocation?
Yes. Sure, Rajat. So I think in line with what I answered in the previous question, going ahead with that, as I said, structurally as a house, we'll back mid and small caps for a longer term wealth creation. Tactically, we see that this year could be a bit softer because several uncertainties have sprung up. Whether I have certainty on domestic growth, the answer is not there. I'm waiting for GDP rebound to happen. Whether there's certainty on the global scenario, obviously not. There is a lot of turmoil going on the global scenario. So in an environment where there's so much of uncertainty, tactically have chosen to bring down the allocation to small caps. So that is what we've done in the last 1.5 months. And we've kind of added this to pockets where we've seen that earlier there were some headwinds in demand, but they have waned. And these could be in large cap, mid cap accordingly. And we've added our weight in those categories where we've seen either these, demand issues, they have been overcome. Or again, the stocks which are already there in the portfolio and our conviction was good, but they have seen correction. We've added some bit of weight there. But at the same time, we've reduced our weight in some of the pockets where I think earlier we were constructive, but we thought that maybe with an environment which is not as conducive, there could be some demand issues. So some pockets where we felt that, okay, demand could get dicey. So we've reduced our weighted share. So this is the kind of realignment in our portfolios we've done. If you ask me in terms of large, mid and small, how it has changed, maybe some bit of allocation from small cap has reduced. Could have been correspondingly added in large cap. Mid cap, we've maintained the kind of allocation that we used to hold.
And again, this is more of a tactical allocation which you've done looking at the current demand situation, which you mentioned in the country. Yeah, this is
And
not
very
a
important,
permanent
very
outlook.
important. As I said, next week is very important to see how things are panning out for India, US, and equally important to see how US faces as an economy the announcement that they make next week.
Okay. So again, now since you've covered the general part, let me come to some of the specific funds, Cheenu, that you manage, and a lot of our partners on the call have got their investors to invest in some of these funds. So Cheenu, I think you and now obviously giving credit to you and HSBC Mutual Fund are very well known for the spectacular performance of the HSBC Equity Savings Fund. So you've been managing this in HSBC since the L&T HSBC merger happened in the last 3 years and before that as well. So I think the Equity Savings Fund, I think everybody, all our partners, all our investors have borne the benefits of early investing, and the fact that I've always tracked your allocation between the arbitrage part and the equity part, and I think it's been brilliantly and very dynamically been managed. So can you explain the current portfolio positioning of the equity savings fund? And if you look at the last 3 years, 5 years, what would be some of the success factors which differentiate the performance of HSBC equity savings fund versus the competitors?
So I think, Rajat, the way we've run our portfolio in equity savings has been we run it like a conviction portfolio.
Yeah.
So if we believe in those ideas, they are there in equity savings, because either ways, equity savings is not like a full-fledged equity fund. It has some, the range is like 20 to 40% of allocation in equity. So we get only those ideas in that portfolio where we believe we have a lot of conviction. So we run it like a conviction portfolio. When it comes to allocation, yes, it was on the higher side, 40% allocation to equities. I think with the market being so volatile, we've brought it down from 40 to 30%, and we intend keeping it, in that range of 25-30% for some time. So we'll wait for the green shoots in the market to again emerge to take the equity allocation higher there. But the style of managing the fund like a conviction portfolio, that remains similar. Time being, we've now taken equity exposure little down in that.
Okay, so from 40%, today you are positioned about 25 to 26%.
28% right now.
Around 28%. That's the equity exposure, the net equity exposure of the fund. Brilliant, brilliant. Thank you for that. I think one last question which I had, and then what we can do is we can just look at the postings, the question postings on the Q&A panel, and I can just put forward questions to impromptu. So the last question which we had collated from our partners before the call started is finally on the outlook on certain themes. So for example, Cheenu, if we have to ask you today 3 or 4 major themes or sectors, your themes are broader, but 3 or 4 sectors where you think significant wealth can be created, where opportunities have become existent now, they have been discovered, and considering also the positioning of the fund house. So which are those 3 or 4 themes which you may want to share with our partners?
So Rajat, themes continue to be more long term, and I think we've been saying, so cap goods remains one of the themes. Only we've become very selective in cap goods. So earlier, maybe the idea was to support infra, railways, everything. Now we've chosen few areas where the spend has to be necessary. So something like defense spend is inevitable, power spend is inevitable. So these 2 pockets in cap goods is something we are backing. Manufacturing, more from the idea of indigenization, because we will be pushing for local manufacturing in various segments. We've already done that and it continues. So that pocket remains. If not from export side, at least from indigenization side, manufacturing should benefit. Consumption, so premiumization is something which is already played out. We've seen how the economy was doing. But I think lots of bits and pieces when it comes to distribution within consumption, the retail chains, etc. I think they are getting newly formed, and that space looks interesting to us when it comes to consumption. And last and not the least is on the financial inclusion side. asset quality of banks, etc., has been an excellent quality since quite some time. Valuations there have always been favorable. I think the last thing paining was the deposit mobilization, which also has been taken care now, where some rules have been eased, and now I think a lot of inflows have started to the deposit. Also, I think that saying that with markets not giving you such excellent return, people tend to look more at deposit. Maybe
The
that
bank.
also could be playing out. So basically, there is some bit of easing on the deposit side that has happened. Loan growth has come off. So that space also, which had those concerns, I think those are off. Apart from that, financial inclusion, financial services, still a space in India which is getting developed, where people are getting their money into financial savings. I think these are
Yeah.
the themes that we largely continue to find attractive from a 3-year kind of horizon.
Absolutely. And I think one of the blessings in disguise was the recent new fund offering which we launched, which is absolutely in line, Cheenu, with the one of the themes, the financial services fund. I think most of our partners would have participated, in spite of the fact that the markets were not looking so rosy in February. I think this is going to be one of the best performing NFOs purely because of the timing and the nature of the theme that we picked up at the right time. So the HSBC Financial Services Fund is available. It's reopened a couple of weeks back. So I would encourage everybody to look at the portfolio and invest again. And Chinu, one more point that you mentioned on manufacturing. I think to your point and to your credit, although the indigenization and the domestic story is strong, but I was just reading yesterday that the PLI scheme actually has added 5 lakh crores of exports, which was not there earlier. So, it's actually now coming down in numbers, and numbers are becoming bigger and bigger to show the impact of certain supportive policies from the government to induce and help manufacturing. Yeah, very interesting. Thank you for this.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.